I'm going to show you how you can massively improve your trade entries continuously in 3 steps. And in fact, this process can help with all aspects of your trading decision making. It's just that we're going to be focusing on the trade entries in this video. And this video is following along from the previous 2 videos we released. So if you haven't already seen those, I'd recommend checking them out first. We'll link them in the description box so they're easy to find. But I'll also quickly explain now why those videos are relevant for this one. So firstly, what we're going to be doing is setting up a flywheel approach that allows us to continue to improve our trade entries over time. So the first video in this little series will talk you through what a flywheel is, why it's important, and how to do it. Then a critical part of this particular flywheel is going to be assessing and trading the potential outcomes, which is a key part of a context-based approach to trading. And that's what I explained in the last video, going through what a context-based approach is, what it involves, why it's important, and examples of how it works. So that's why you should check out those 2 videos first. It will help this one to make a lot more sense. Now, this one we're going to break up into different chapters based on the 3 main points in the flywheel that we're going to be establishing. So that is assess potential outcomes and estimate probability, expectancy, and calibration. So let's get started. When I'm looking at a potential outcome and assessing if it's a possible trade opportunity, I'm judging the quality of the trade. Now, broadly speaking, I look at the quality of the trade as being a combination of the potential risk, the potential return, and the potential success rate. Now, a lot of traders, especially new ones, will focus on just 1 or 2 of those factors when they're assessing a trade opportunity. But I really believe you can only make a judgment about, how good a trade is by assessing all 3. Like, for example, an opportunity might have a really low potential risk and really high potential returns. But if the success rate is too low, it means that over the long term, you'll end up losing money. It'll be like death by 1,000 paper cars. On the other hand, a trade might have a really high success rate, so it's going to succeed far more times than it's going to fail. But if the risk is too high, it means that the occasions that it does lose will wipe out any profit. So this is like picking up pennies in front of a steamroller. So the quality of a trade can only come from the combination of these 3 factors, giving an overall outcome that will be profitable over the long term. In the last video, I explained how you should determine where to take the actions with your trades, such as scaling in or out or exiting the trade. It's based on the changes in the context, however it is that you determine the context with the approach you're using to trade. With how I trade using the Duomo method, this will mostly be determined by either the structure, the path of least resistance, or some sort of change in the market dynamics, like if there's a change from steady state to herd activity. So that means with all of this information, we can already assess the potential risk and return of all the different outcomes. So that just leaves one more factor to assess the quality of each of the outcomes, and that is the potential success rate. In other words, the probability of each outcome occurring. Now, determining the probability of an outcome is always going to be an estimate. There's never a way we can say with certainty what the probability is. Unlike something like flipping a coin where we know there's a 50-50 chance of heads or tails, we can never have that sort of certainty. However, if your method of trading truly works, then your approach to analysing the market should be able to help you understand what factors are going to have a stronger or weaker influence on the future price movements. So this means you should be able to estimate the probabilities. The best way to approach this is to start off by being less precise and then over time building up to being more and more precise. So for example, if you're brand new to trading, it's going to be very difficult for you to know the exact percentage probability to assign to an outcome. Like, why would it be, for example, 35% and not 36 or 32%? You wouldn't have the experience, the knowledge, or the points of reference to make that sort of precise judgment. So instead, when you first start, you can just assess the probabilities as being either low, medium, or high. And remember, these are just comparative probabilities rather than having to assess something as a standalone probability. So what I mean by that is that you're not going to be judging an outcome in isolation. Instead, you're looking at all of the potential next outcomes and comparing them against each other. What's the likelihood of all of them? So maybe one of them is lower than the other one. So one is low, one is medium, and one is high. And once you start progressing from that, maybe you can start using something like quintiles instead. So you can rank them from 1 to 5, with 1 being low probability and 5 being high probability. So now you can get that little bit more precise. And eventually you can move on to using percentages, where you can get really, really precise about things. So already you may be able to tell how the next steps in the flywheel are going to work with this, because a bit later on we'll be discussing the important step of calibration. But first, let's move on to the second step in this process. If you look at traders on social media or on websites like TradingView, where traders are sharing their trade ideas, you'll see many charts that look like this one. So what is it that traders are doing when they mark up their charts with those arrows? If you watched our video on context-based trading, you probably guessed that they're mapping out a potential outcome. Well, that's great, that's what they should be doing. But then my question is always, why have they chosen that specific outcome? They've only marked up one, or in some cases 2 outcomes, but why that one? Why do you think they've chosen that one? Well, I think for most traders, they've chosen the outcome that they think is most likely to play out. If that wasn't the case, why would they share that chart publicly? They'd be sharing something that they don't think is a likely outcome. So they're setting themselves up to look wrong publicly. And that's a thought that we'll come back to a little bit later, because there are some flaws there. But this is something that many traders do with their own trading, whether they're sharing it or not. They do their analysis, they think about what is most likely to happen next, and then that's what they trade. And people wonder why 95% of traders lose. If you think back to the last section we just covered, we know that there are 3 broad things that we have to consider for the quality of the trade. There's the potential risk, the potential return, and the potential success rate. So if you're just trading the outcome you think is most likely to happen, what if the risk and return means that actually over the longer term you're going to be losing money? Yes, you might have profitable trades more often than you have losing trades, but it's sort of like picking up pennies in front of a steamroller then. The losing trade comes along and wipes you out. So instead, we need to think about the expectancy of each of the different outcomes. And by assessing the probability of all the potential outcomes, rather than just the one we think is most likely, we're able to do this. You can think of it this way. For each of the potential outcomes, if you figure out the risk and return based on a context-based approach, and you estimate the probability, if each of those outcomes played out for 100 different trades, which one would have the biggest profit? What would the overall profit or loss be for each of those individual outcomes? What you might find is that actually one of the less likely potential outcomes is actually going to lead to bigger long-term profits. So it might not have the highest success rate, but overall it looks like the best option to be trading. You may even find that more than one of the potential outcomes could be traded. So to get this right, we have to actually think beyond the first level outcomes. I always think about trades in terms of this little diagram here. You have break even right in the middle there, and then extending out on each side, you have the profitable outcomes going from small profits to extremely profitable moves, and you have the opposite on the other side for losses. And so based on that, our aim with each trade is to reduce the probability of the big losing outcomes without smothering the trade too much that the probability of the big potential outcomes becomes too low. And each different potential outcome will have a different balance of this diagram. Some will have a low probability of the extremely profitable moves, but a high probability of small profits, like if you're trading in a range without much chance of it breaking out of that range and you just trade from the top to the bottom or something. Whereas others might have a higher chance of smaller losses, but a relatively larger chance of bigger profits than the other safer trades. Now that's where things get a little bit more complex with trading, as that's all about how you can use your trade management to stack the odds in your favor. And that's something we won't be covering in this video, but if you're one of our members, we do have lots of previous live streams discussing this exact topic that you can find in the app or the members area, so check it out. But basically, the way to succeed in trading is to trade the outcomes with the best overall expectancy. You need to open trades with the longer term in mind, not just thinking about that individual trade, but thinking to yourself, if this exact same opportunity played out 100 different times, what would the overall result be? even if the success rate is low, and therefore it means that you're more likely to lose that trade than to profit, it's okay because your success as a trader isn't determined by that one trade, but by your longer term performance. And the way you achieve good long-term performance is by trading the better outcomes. So you should never just automatically back the favorite. And this brings me back to the traders who are sharing their ideas on social media and other platforms. Most of the best trades have a success rate below 50%. They lose more often than they succeed, because they'll usually be with asymmetric risk returns. So if it's going to profit, the price has to move further than if it's going to be a loss. So that means that there's a lower probability already of it occurring. Therefore, people sharing ideas on social media are in a lose-lose situation. And that's why you shouldn't follow those trade ideas. Because either they know the trades will lose more often than they succeed, and in which case they know they're going to look bad to their followers more often than not, and therefore they probably won't even become popular in the first place. You probably haven't come across them. Or on the other hand, the trades succeed more often than they lose, and in which case that trader probably has a negative expectancy over the long term, so you wouldn't want to follow their trade ideas anyway. The other alternative, of course, is that they're actually just full of shit and lying about their trades and the outcomes. But anyway, we're not going to get into that. Let's go on to the third and final step. Since we now know the three broad factors that determine the quality of a trade, if we want to build a flywheel around all of this, we'll want to focus on improving two things. So the first is our ability to find opportunities that are higher quality, and the second is our ability to assess those opportunities accurately. Now, finding the opportunities will be based on the method of trading that you're using and how good you are at it. So if you want my specific advice with that, I'd say to learn the Duomo method and then use deliberate practice until you've learned the skill deeply. But for the flywheel we're looking at in this video, we're more concerned with that second part, which is assessing the opportunities accurately. It's never going to be possible to always estimate the probabilities completely accurately. That's why it's an estimate after all. Instead, the calibration process is all about correcting our course to get as close to accurate as possible, knowing we're probably never going to hit it dead on. Now, I always think of this like a remote control car. You have that little calibration stick underneath. So when you're driving straight with the car, if it starts veering more to the left, you'll adjust the calibration to try and offset that. Perhaps you go a bit too far and now it's veering too much to the right, so you'll change it again till it's a bit more how you want it to be. So it's this ongoing calibration process. And that's what we're doing with the calibration of our success rate estimates. This is something that Philip Tetlock talks about with his work on forecasting and finding super forecasters. They're making predictions about uncertain future events. So in that case, how can they actually improve their ability to make accurate forecasts? Well, they calibrate by measuring how close their prediction was to the correct end outcome. And they use something called the Breyer scale as their guide for how far off they were. Now, for our trading, we just want to keep things really simple. We want to make our estimations, record what those estimations were, and then use the data from our trades to see how close we were. This isn't an exact science, and it's not the most precise thing ever, but it will certainly help you to calibrate your thought process. So for example, let's say you have 100 outcomes where you thought there was a 30% chance of them occurring. However, when you look at what actually happened in the data, you can see that actually 40 of those outcomes occurred. So 40% of the time that outcome played out. This means that you underestimated the probability of that outcome occurring, and you can now calibrate your future estimations by increasing them slightly. So imagine for similar situations in future, you now estimate that the probability is 40%, but now when you look at the data from the next 100 outcomes, it was actually 35%. Well, now you overestimated and you can calibrate lower in future. Like I said, it's not perfect, partly because not all of those outcomes will be identical. So it might be that for some of them you overestimated, some of them you underestimated, but that's okay because this isn't about learning to get every single prediction exactly right forevermore. It's about calibrating so that you can stop vastly over or underestimating and get much closer to being in the right ballpark. So what you'll tend to find is that when you first start doing this, you'll be very, very far from being accurate. So this calibration process will give you the biggest bang for your buck at that point in time, as you can massively correct your course and see big changes straight away. But over time, as you start getting closer and closer to being accurate, any over or underestimations as a whole aren't going to be so dramatic. So at that point, either you refine the data further to get more precise about what each type of situation is, or you just accept that you'll never be able to get it exactly perfect, but close in this situation is close enough. Now, this is part of the reason why when I'm assessing a trade opportunity and looking at the expectancy, I want to make sure that I have a bit more of a margin of error. So for example, if I calculate as an estimate that over 100 occasions of this trade playing out, I'd only make a total return of 4%, then yes, it's profitable, but only marginally so after that many trades. So I know in that situation, if I've estimated the probability even slightly wrong, I could be in a losing situation overall. So instead, I need more of a margin of error to make up for my own imprecise judgment. And finally, an issue that some people raise about this whole process is that they don't have enough trades to have a big enough sample size for each probability level. But remember, if you're assessing the probabilities for all outcomes, not just the ones that you're trading, then you'll have a huge sample size. So it doesn't matter how many trades you actually open, it's about the number of situations you assess. You just need to make sure that you collect the data meticulously and you categorize them appropriately. So let's take a look at that overall flywheel that will continuously improve your trade entries, and actually the same process will improve all of your trade decisions, as really you're always going to be considering the same sort of factors before you make any decision in the markets, whether it's opening the trade, closing the trade, scaling in, scaling out, or taking no action at all. So this is going to help everything. So you start off by assessing the probability of all the potential outcomes, as well as the potential risk and reward by using a context-based approach. Only by doing that can you really determine the quality of each potential outcome and figure out the expectancy, perhaps just by calculating how it would turn out after 100 trades or some other large amount. You then trade the one or more outcomes that have a positive expectancy, giving a margin of error to account for your lack of absolute accuracy with your probabilities, and you then collect the data from the trade so you can go through a calibration process. This is going to help you to limit how much you over or underestimate the probabilities for future trades. So this means when you go on to assess the probability of the next potential outcomes on the next trades, you'll be more accurate, which will lead you to making better trade decisions, to lead to you having better performance and better results. These trade decisions lead also to more data being collected, so you can calibrate further, and around it goes. So there you have it. The topics that we discussed in this video and in the last two videos are quite complex, and they could take hours to discuss in detail with different examples and so on. But we condensed it down as much as possible, and hopefully you got the key points. So now you can take these different ways of thinking and apply them to the different areas of your trading and keep on improving. This is how you can really start developing as a trader, becoming more skilled and improving more and more over time, rather than just following the same path that everyone else goes down that doesn't lead to success, that just involves memorizing some trade entry criteria and then waiting until it comes up in the market and just following what you're told. Instead, you're going to be assessing situations in the markets, improving your accuracy, improving your decision making, and becoming more profitable. So don't forget to subscribe to this channel, and also check out our second channel, our new one, Market Movers, where we have short videos on the financial news and fundamental analysis. Please do hit that thumbs up button if you like this video and the 3-part series that we've just finished, and I will see you in the next one. Thank you so much for watching. Take care.